If you had $100,000 to invest today, would you put it into the share market or use it as a deposit on an investment property? It's one of the biggest financial decisions Australians face, and the answer isn't as straightforward as many people think. Both shares and property have created millionaires, but they build wealth in very different ways. In this video, we'll compare them side by side to see which investment comes out on top. Let's start with the share market. Investing in shares means buying a small ownership stake in companies. Instead of owning a house, you own part of businesses that can grow over time and pay dividends. With $100,000, you could build a diversified portfolio of Australian and international shares or invest in low-cost ETFs that spread your money across hundreds or even thousands of companies. One of the biggest advantages of shares is that they're easy to buy and sell. If you need access to your money, you can usually sell your investments within a few days. Shares also don't require tenants, property managers, repairs, or ongoing maintenance, making them a much more hands-off investment. Now let's look at property. In Australia, $100,000 is unlikely to buy an investment property outright, but it could be enough for a deposit on a home worth around $500,000, depending on your lender and borrowing capacity. Property gives you something unique called leverage. Instead of investing only your own $100,000, you can borrow the rest from the bank. If the property's value increases, your gains are based on the full property price, not just the amount you invested. This is one of the biggest reasons property has helped many Australians build wealth over the long term. However, property also comes with ongoing costs. You'll need to budget for mortgage repayments, council rates, insurance, maintenance, property management fees, and periods when the property may be vacant. Selling a property can also take weeks or even months, unlike shares, which can usually be sold much more quickly. So, which investment has delivered better returns? Historically, both Australian shares and residential property have produced strong long-term returns, although performance varies depending on market conditions, location, and the time period you're looking at. Shares have the advantage of paying dividends, which can provide a regular income while your investment grows. Property, on the other hand, can generate rental income and may benefit from leverage, potentially increasing your overall returns if property values rise. Risk is another important consideration. Share prices can move up and down every day, sometimes quite dramatically, especially during market downturns. Property prices generally don't fluctuate as often, but they can still fall, and owning property exposes you to risks such as rising interest rates, unexpected repairs, and tenant issues. Neither investment is risk-free. Tax is also something to think about. Both shares and property may qualify for capital gains tax discounts if held for the required period. Australian shares may also pay fully franked dividends, which can provide valuable tax credits for some investors. Property investors may also be able to claim deductions for eligible expenses, depending on their circumstances. Because tax rules can be complex, it's always worth getting professional advice before making a major investment decision.